Okay, this time we'll turn and start talking about our two portfolios. Most of you on the call have these portfolios, OE and OS. They had a very good year last year, and they've had a great start to this year. So, Chris, start this off.
Yeah, just to go back and give people a reminder of why we created these opportunistic strategies at Waterfront. We saw the trend of people wanting to just buy the S&P 500 and think that is just a good enough exposure. And we don't believe that's a good enough exposure. It's heavily skewed toward technology companies, good ones that can make money, but at the same time, it doesn't give you a broad exposure. So what we have done for a lot of people is pair them up with that type of large cap growth investing in S&P 500, pair them up with one of these opportunistic strategies, or at least have a portion in the opportunistic strategies. And they tend to target smaller companies, smaller value companies. And these are companies that don't get as much analyst coverage and sometimes are under the radar. There are certainly large cap holdings in there. They tend to be value on the large cap side, and there's international holdings as well. But the target is really to pair up a value strategy and one that hits the category small cap growth in a meaningful, small cap value, I should say, sorry, in a meaningful way, and pair that up with some of the more growth oriented strategies. How is it managed? Well, everyone has their own separate account. They're managed in unison. A basket of stock is bought. You're buying Apple. I buy one block, and everyone gets their pro rata allocation. All the accounts largely hold the same positions. There are some timing differences that create small differences, but we do manage for taxes also. So some people will have modest security weighting differences because of taxes. Commissions have dropped so low in the advisor space that we think it makes sense to have that flexibility that comes with a separately managed account versus a pooled fund. So that's why we keep it as a composite of separately managed accounts.
Okay.
All right, why did we create the OE versus the OS? The OS is the one that has existed since 2016. Well, we wanted a lower min option. That was definitely a consideration. The OS will hold bonds, and really you need to have a little more money to be able to hold bonds in these type of strategies, the way they are bought. But there are plenty of other differences. The OE is a little more higher conviction, smaller number of names. There's more trading in the OE, I will tell you, than the OS. I will tell you that when I see a company that the price has gotten a little too high, I'm more often to make a clean cut and move on in the OE versus the OS. It's maybe a pair back to half of what it used to be, or the OE, or let's just move on. There's definitely more buying and selling in the OE than the OS. It's actually the OS is very modest turnover. Certainly track record differences. I use international funds, some exchange traded funds, and a couple mutual funds to up to 10% of the international, up to 10% of the overall allocation, and to cover some of the international allocation. We do that with OS. The OE has 100% individual names. There are no exchange traded funds or mutual funds in it. Cash positioning, the OE is targeted to be low at all times, and the OS will tactically hold cash, and a modest difference in management fees, really due to the size of the required minimums.
Also, some of you will notice the first line, the $250,000 requirement, that is for the OS portfolio. We did raise the management fee. That is for only new accounts. So for all of you that were in the early birds in the portfolio, your management fee is 30 basis points, but going forward, everyone else will be at 40 basis points on an ongoing basis.
And those are still really competitive fees compared to mutual funds that invest in some of the smaller cap areas. So what that all leads to is generally the OS will have a little more downside protection. be a little less volatile. But when the categories are really ripping, when they're moving, the OE should do a little better. And true to form, things were very volatile in the small cap space in 2020. I shouldn't say true to form, but small caps in general are going to be more volatile. And certainly 2020 was an extremely volatile year. So the OE and OS, they're going to have a little more volatility, but their target is a 2 to 3 year time horizon. And the year started off pretty bad. Small caps got as bad as it was for S&P 500 in March of 2020. Small caps got hammered way worse than even the S&P 500. But they came roaring back as some of the stimulus came into play. Certainly the Pfizer and Moderna news that they were over 90% effective was a big deal. And that hit in the fall of 2020. And there's been some good security selection. I really had some companies that benefited significantly from COVID in the mix. And it's been a good start for OE, especially here in the early part of 2021. And we'll see how 2021 plays out, but returns are off to a good start. All right, the longer track record OS, the gray line is what you're looking at. When value was strong in 2017, actually, it wasn't as strong a year for value as that return would imply. There's some good security selection, really benefited from having the right stocks in 2017. A little bit of weakness compared to the markets in 18 and 19, but came back with a strong year in 20 and then off to a really good start in 21. So we're gonna have a 5-year number on this, and barring something crazy, it should be quite a bit better than even the S&P 500. And if you look at the Russell 2000 value, which is the blue line, that is small cap value stocks, and they're quite a bit below what the S&P 500 has been able to do over the previous 5 years. Some modest positioning changes. I added a couple telecom stocks. Telecom stocks are more boring. They tend to pay high dividends, but they're more boring than cyclical stocks. But I was just sort of seeing some of the really sharp moves to the upside, trimming some of that and moving to more stable income, as I have a not as optimistic a viewpoint as some others out there. They're all still largely value stocks. We have a few growth stocks mixed in, but it is definitely a value tilt. One thing that I don't show here, but you would see in some other presentation materials, is I have a 27% allocation to technology. Technology is, I think, a great category to be in, but there's plenty of technology stocks that are perceived to be inferior to the juggernauts, the big large cap growth stocks. But I don't think that's the case. And I think that's playing out. It's certainly been playing out recently, some of their numbers, that some of these technology stocks that are considered value actually are really competitive. Their software offerings and just their ability to compete is way more than people are giving them credit for. And their stock prices have been rising accordingly. So value doesn't necessarily mean you're investing in a whole bunch of utility stocks or finance or real estate stocks. You can be invested in cyclical stocks or technology stocks, materials. Well, materials is definitely a value category, but you could be invested in technology and not have it be a company that's trading at 15 times sales. There's a lot of value companies even within the technology category. I am concerned that once all this stimulus filters through the system, that could lead to a correction in the latter part of 2021. And this euphoria is just, anyone who looks at what is happening in the markets every day should be a little bit scared with just the stocks that are being driven up. One thing I didn't put in here is I'm a big believer that the Biden administration is going to get their corporate tax increases through. And the estimates are starting to come out, and they think it's about a 10% hit. If a lot of particularly the really important thing is if they get the global minimum tax, or multinationals get taxed higher than they have been in the past. That would be a big deal for a lot of the S&P 500 companies. Upwards of a 10% EPS hit are some of the numbers I've been looking at. That's not insignificant. That would take, some sales out of this market. That would get people to reassess, I think, a little bit, because 10% hit is significant. International does not have that. They're already taxed at higher rates than the U.S. is, U.S. multinationals. So those are some thoughts for the latter part of 2021.
Chris, name some of those technology stocks that you were mentioning that are a little bit boring.
Well, one that's done very well is Hewlett-Packard Enterprise. So, who thinks of Hewlett-Packard anymore? Well, if people remember, Hewlett-Packard split into 3 different companies years ago. So they shrunk, and their enterprise business is, with everyone thinks you got to have cloud, you got to have cloud. Is enterprise spending still relevant? Well, beneath the surface, if you look at them, they have a really good edge computing platform that's a sort of cloud as a service at the edge, not in big sort of cloud data centers. Their software portfolio for edge networking is really good. Their analysts are just starting to upgrade them on their software portfolio, but they've had this software portfolio for a while. They're high performance computing. They're the leader in the market. It's still a sophisticated category that demands respect. They actually are, I think, the largest server market share in the world. Just because they weren't perceived as cloud only, they've got some of these companies that begin knocked down and unfairly knocked down. They're sophisticated companies with a lot of talented offerings.
In the portfolios, kind of one company everybody's talking about has been Tesla over the past year. Why do we own General Motors and Porsche in the portfolio versus a Tesla?
Well, Porsche, I'll start with that one first. Well, Porsche, the holding there, we actually own Volkswagen, but the market's created a disconnect between the fundamental valuation of that Porsche stock and Volkswagen stock price in the market. So we switched from Volkswagen to Porsche. Porsche owns 53% of the common shares of Volkswagen. It's not the stock. That holding is not the car company Porsche. It's a different Porsche, which their entire valuation is based on what the value of Volkswagen is, because they own 53%. So Volkswagen, obviously, I am a believer that EVs are coming sooner than people realize. I see the technology trends, and I think they're coming fast and furious. I really do. I think we're a couple of years away from the inflection point. Volkswagen is about as competitive as anyone in the world. They invested billions. There's no way they're not going to be able to compete with Tesla. They just have the manufacturing prowess. Unless there's a battery breakthrough that goes to one or the other, they're all going to be about the same cost in terms of building out their EVs. Obviously, Tesla's valued, 5 to 10 times more than these traditional automakers who have their plenty of profits coming in from traditional internal combustion engine vehicles as well. But they have the same growth profile, in my opinion, as a Tesla. And GM's been under the radar, investing in EVs for a while. They're really going to start hitting the market in the next couple of years. They have a proprietary battery chemistry, Ultium. They're running a JV with LG Chem. They're making some good noise on that. Honda has decided to strike a licensing deal to use some of GM's and battery tech. You know, Honda's a big, significant automaker signing a licensing deal with GM. I'm not aware of any company that has signed a licensing deal with Tesla. So some of these traditional automakers are viewed as if they can't compete, and they can compete. And we're starting to see that reflection in the market right now.
When we first started out the portfolio on OS, we had a very low exposure to international. We've just gone almost to the other side, where developing markets around 33% of the portfolio, emerging markets is now over 10% of the portfolio, and individual stocks. What's been the change? Why in the past 4 years we flipped?
Just really valuations. The valuations internationally are less. You get good companies for a lower price, and they won't have the tax burden that's coming to some of the U.S. companies. But you could look at the same company doing the same exact thing, and these are multinational companies. They're all selling in Asia, Europe, and the U.S. And you could have a company in the U.S. doing the same exact thing as one in Europe, and the European company is cheaper. It makes no sense. It's just differences in investor appetite in those different geographic areas. And obviously, we want to be invested in the companies that have the best valuation. So that has led to some money shifting to international stocks.
When you say cheaper, how much cheaper are you talking about?
Well, I mean, it varies. So I mean, the international indices are 14, 15 times earnings versus S&P 500 at 23 times earnings. So, you know, that's a huge difference in and of itself. But if you also get this EPS hit coming from corporate taxes, that would open that gap up even wider. So those are noticeable differences. Also, you know, Europe has been we've been lucky in the US with Pfizer and Moderna supplying us really well. Europe ordered a lot of the AstraZeneca. That's turned out to not work out so well. They didn't order as much Pfizer and Moderna. So they've been slower out, and the variants have been much more problematic in Europe. They've been slower on their vaccine rollout, but it's not like they're a year behind. We're talking 3 months. You know, the markets are pretty soon, at the end of 2021, Europe's going to be well vaccinated too. And so their economy is going to open up. Their stimulus has been a little bit delayed. So things are going to improve in Europe. Obviously, we've had a little bit of a head start on solving COVID, but we don't have a huge monumental head start. Stock prices are based on earnings over a decade.
So the portfolio, small and mid cap on both OS and OE, are running around 36 to 40%. Reason for that over large cap US?
Well, actually, it would probably be higher if we haven't had such a big run in small caps. I can tell you that the early part of latter last year, early part of this year, we've trimmed some of the smaller cap exposure, and you know, some of those telecom stocks I referred to. They're large cap and they're stable. So I've shifted a little out of small cap just because if there's a market correction, they just hit small cap stocks more. It's just the way it plays out. They have more beta. And it shouldn't necessarily be that case, but it's just the way the markets tend to work. And so you want to not have a huge exposure to small cap if there's a market correction.
Looking at the portfolio, let me jump to this one. So here's another one. Everybody loves Amazon. Nobody's going to go to a store. Everything's going to be done online. Why do we own Macy's?
Well, Macy's is not a high allocation. I'll start with that. There's stuff way more higher conviction names than Macy's, but we've owned that one. That one's partly based on price. You could look at some of the other retailers, and there's definitely a price value dynamic that plays out with that particular holding. You know, they're going to hit 10 billion in digital sales pretty soon. what a lot of these storefronts are doing is doing a great job of doing digital out of the store. I mean, Target was the clear COVID winner in there. Target cleaned up doing digital out of the store, and they're all doing that. You know, these are turning into distribution centers, the stores. Macy's owns all their stores, so it's not a huge cost, or the ones they lease at lower than market rates. So to have those stores be distribution centers is an efficient way of doing it. Actually, when people pick up their items curbside, it saves shipping costs. So that one, there's a lot more granularity to get into why that's a particular retail holding, but you know, it's, even though I do like it, it's not a high conviction name.
Top performer, poor performer. Top performer being DQ, poor performer being ERJ.
Well, I mean,
How did you find the top performer?
That's based on, yeah, it's really when people came in.
Yeah.
DACO is solar polysilicon raw material that goes into solar panels. One of the lowest cost producers in the world. They're based out of China. Like it or not, China has wanted to own solar panels, and they did. They do. Pretty much the entire global solar supply chain goes through China. The profitable company, and you know, they were way undervalued when we bought them, but they got a boost from sort of this speculative market where people are just bidding up clean energy stocks to, you know, crazy levels. So
Poor performer, ERJ.
yeah, well, that was Boeing canceled when COVID happened. Boeing was supposed to buy Embraer, and they canceled that when on COVID. So obviously commercial aircraft is a tough industry, but they had the double whammy of getting the merger canceled on them. So
Talk about commercial air. If any of you been on a flight lately in the past month, you know it's been extremely crowded. So it's been a dramatic change. One thing to let you know, all of you that are on here that have the OS and OE, we've made a decision firm-wide that Waterfront, we're going to close those portfolios once we get to around 100 million in assets. That's just kind of going to be our capacity at this time. So if you know anybody else that would be interested and want more details about it, let us know.